Kyle, I'm so excited for this. I heard so many great things. I also love your writing. It's one of my favorite pieces of writing in venture. So first, thank you so much for joining me today.
Yeah, thanks for having me.
Not at all. I've been excited for this one, especially when I saw your suggestions for the show. But I want to start with a little bit on you. So, many great firms you've worked at, but how did you first make your way into the world of venture and most recently come to be a GP at Coatue?
Yeah, so my journey is very circuitous. I didn't know anything about venture startups growing up. I was obsessed with film growing up. And so when I got to school, my original major was actually filmmaking. My magnum opus that I created, you can still find on YouTube, was Pokemon Love Song. So I was very into film and videos, and I was paying for college doing, wedding videos and commercials and things like that. So that focus on film was a big part of my life. And then eventually got to the point where I had too many clients. And so I just started farming them out to other creatives. I'd take 2% on whatever they would make. And before I knew it, I realized I was much better at getting jobs than I was at making videos. And so I kind of transitioned to that as a full-time job. And I joke that I was running a creator marketplace long before it was cool. I didn't know to call it that. But I built this really crappy website. I expanded to graphic designers and photographers, and I was helping them get jobs and do all these different things. So that was my first exposure. I didn't even know to call that a startup. You can ask my wife. For the entire time I ran it, basically, I called it a project. I was just working on a project because I was so used to a job being a very different thing. And eventually I ended up selling that business, and I was trying to figure out what to do next. I was talking to a friend, and they said, well, what did you like most about running your company? And I said, I loved being this resource for these passionate people who were running their building their own businesses. And I loved that they could rely on me, and I could go help, knock down walls for them or find answers for them or whatever. And my friend said, well, that's sort of what venture capitalists do. And I said, well, I don't know what those words mean when placed together. And I sort of stumbled backwards into the world of venture. I'd been running my company in Utah. I worked for a seed fund called Kickstart in Utah, and that was kind of my education in venture. But that's what led me out to the Bay Area. Eventually, I wanted to see more than just seed investing. I wanted to see lots of different companies, and so jumped to the Bay Area and worked at firms like TCV and Coatue and Index, and eventually Contrary is where I decided to hang up my hat and be able to put my fingerprints on something and actually help build something.
It's rather a shame you don't actually have one of these, because then we could both be kind of hanging out that somewhere. But gotta love a TikTok audience. But I do want to. I'm doing a very weird thing today, because normally we obviously have a quick fire at the end. But you've worked at, as you said, TCV, Index, Coatue, in quite a short amount of time, Kyle. So my question to you is, we're going to go through each one and just go for one lesson from each and how it changed your mind in a quick fire. So if we start with TCV. Lesson, and how did it shape your mindset?
Yeah. So, TCV, then Coatue, then Index. It's a very different, it's a real smattering of opportunities. TCV, I credit a lot where I learned a significant amount. I mean, I was very drinking from the fire hose, baptism by fire kind of stuff. And TCV's changed a lot since I was there. When I was there, it was very much like a private equity style of investing. It was really looking for diamonds in the rough. And the people at TCV were never afraid to get their hands dirty. And for me, that really changed my perspective of what it means to be an investor. Like, the way that I think about it is, it's actually funny. I've really never resonated. I've never really liked the memification of venture. Because my whole career, I've had this we do the work attitude that I learned at TCV. And so I don't ever feel like I would passively say, hey, let me know how I can be helpful. I just start doing stuff. And then I go to the founder and I say, hey, I did this and that, and is that your top priority? If not, redirect me. What else can I do? And that was definitely a big part of TCV. Okay, so that's TCV. Tell me, what was the learning from Index? Well, let's do Coatue, because that was the order. I feel like I actually my journey in order was it really was if I could have written the book, this is how I would have written it. But it was absolutely scattershot.
Hit me, Coatue. What was the lesson from Coatue?
So Coatue, again, it's very hedge fund style of investing, right? If TCV was the private equity, Coatue was the hedge fund. And it's, there's some aspects of that are less fun. Like, hedge funds are very intense. They're very competitive inside and out. But one of the most eye-opening things that I learned was not just, hey, we get in and we do work, but we do work in markets that matter and after opportunities that matter. And so at Coatue, I learned this idea from Thomas Lafont. He called it TAM arbitrage. It's this idea that you can work, and if you can do the work and understand the market better than anyone else and appreciate that it's actually bigger than anybody else gives it credit for, that can help you pay higher prices. Sometimes that can come back to bite you if you don't, who knows? It's always difficult to predict how big markets actually are. But if markets really do turn out to be larger than anybody else gave them credit for, not only can you pay higher prices, you can get more aggressive with burn, you can grow more quickly, you can experiment a lot more because you have a more fundamental understanding of the market. And it's kind of the Buffett-ism, right? If a good manager meets a bad business, it's the reputation of the business that remains intact. I think the same way about a market. If a really good founder goes and tackles a really crappy market, that market's still going to be crappy. The question marks are going to be around that founder's ability to tackle a market if it's not big enough.
I have recent learnings from the last 12 months that markets matter more than anything. Markets matter more than founders. You need a sufficient level of founder, but if you have a sufficient level of founder and operator in a fucking great market, win, go.
Absolutely.
You agree? Yeah, I'm glad I'm not alone in that lesson.
Not everybody agrees.
Not everyone agrees, but they're wrong, and we don't pay attention to anyone that disagrees with us. Final one then, index. How did that shape your mindset?
Yeah. So, and again, I sound like Goldilocks, right? I was jumping around, testing out, just finding what's just right for me. Index, the way that I think about index, it's a little bit different. It's not just the way that there's not one thing that impacted my way of thinking about investing. For me, I felt like index was like graduate school in venture capital. Like there was so much, and maybe this was my mindset, but even before I joined index, I'd already started, remember I'd started a company before. I didn't know to call it a company. Now I knew what a company looked like, what a startup looked like. And I started to feel this entrepreneurial itch, but I liked investing too much. And so when I'd think like, well, should I go start a company? Should I go join a company? I really like investing. I don't think I want to leave it. But so I was in this like opportunity canvassing mindset. And I sort of like directed that energy at venture. And so while I was at Index, I was constantly paying attention to how we did things and studying the way that we did things. So how do we make decisions? How do we incentivize people to take risks and build relationships and stuff like that? And a lot of that study, it comes out in my writing, right? It's the reason that I write about like, what is the art and science of venture? It's because I felt like I was studying it. And it's one of the things that led me to Contrary, where I wanted to try and take what I had kind of observed in three very different styles of venture, Index being the kind of venture classic, but it's kind of take those learnings and try and go build a new model. And Contrary is that sort of, avenue for me to go do that.
I didn't take that vague answer. What is the one single thing from Index that you took with you to Contrary and changed the way you think about what you do at Contrary?
Venture, if I had to sum it up, venture is meant to be studied. And while I was at Index, there were good and bad things, I started to appreciate how much you have to actually treat your effort as something to be studied and learned from, postmortems and stuff like that. Like there is an actual psychology and study that every firm should apply to what they do, good and bad.
One of the biggest bits of bullshit advice I think there is, which is like, oh, don't worry, no one really knows what they're doing. To me, this is complete crap. People do know what they're doing, which is why they're often where they are, and you should learn from them and seek them out. Do you agree, or do you take the ever-changing circumstance and time, you do you style?
The way that I think about it is that everybody knows what they're doing, right? I think that everybody is acting deliberately and trying to do things in a certain way. I think the thing that I don't take for granted, and I think the reason people say stuff like that is that, nobody knows what they're doing. We're all just kind of making stuff up as we go, is everyone's trying to soften the blow of being wrong. And so we try and say like, hey, we're all just doing our best. We're all doing this or that. But there are people who are exceptional at what they do. And there are people that are repeatedly really bad at what they do. And I think the biggest difference between those people is that the people who get really good are the people who learn and grow and pay attention to how they do stuff. And then they get better at it. And so those people do know what they're doing. Not only what they're doing, what they're trying to accomplish, but they know they're capable of their craft and their skill because they've studied it. Like I feel like that makes the biggest difference.
I absolutely agree with you. I want to start on, we spoke about kind of three incredible firms there, but from, the prior generation, bluntly, I want to talk about the current landscape that we have in venture today. And you said before, and you said in an email, I love this, differentiation is going to kill the long tail of so-so venture firms. It was great cliffhanger, by the way. What did you mean by this?
So Josh Wolf made this prediction back in February. He said that in his prediction, between 50 and 75% of active investors in the private markets are just going to disappear within the next few years. And for me, the way that I think about that, about the sort of what is a so-so venture firm, what is differentiation really, people are starting to care more and more about the holistic character of these institutions that they work with, right? A reputable bank may not be enough to acquire customers anymore. Like, people care a lot more about what the identity of this firm is, and I think founders are progressively going to look for more distinct characteristics in the firms that they work with, and I define that as differentiation, right? Is how capable is somebody externally able to articulate you as a firm? And if you can't answer that question very clearly, it's going to get harder and harder and harder. And so I think the ways that firms look to differentiate themselves is going to get progressively more interesting.
I think that what we're seeing actually is kind of the disarming of firm power and the migration towards individual and partner power. And so the ways in which firms differentiate themselves, I actually don't think will change very much, or I don't think will change as significantly as the ways in which partners will try to. I think a recent example of this is Logan Bartlett, obviously, who's done actually a very good job building his personal brand from nothing very quickly. But I think it's the partner characteristics that will change much more rapidly and significantly than firm. And I think we're seeing that now with founders choosing partners, not firms.
I would agree with that. You would know this because you were featured prominently in the writing. But this was one of my first articles that really blew up, was the unbundling of venture capital, and the evolution was sort of this sort of three phases of how firms have been structured. And I think, to your point, one of the things that I get a lot of pushback on is people say, well, I think by and large, things are going to stay the same. And I think that venture will look and feel very similar and not change so dramatically that you wouldn't, 20 years from now, it's not like you're going to look back and not even recognize how things work. But there are subtle changes that are happening. And the way that I described it in the article was you have these monolithic brands, the old school, 60s, 70s, 80s, whatever. You've got the Kleiner Perkins and the Sequoias and stuff like that. And they sort of just are, you almost abstract away the partners. It's focused on this, almost like a bank, this monolithic institution. The next phase of that progression was sort of what I called these like fiefdoms. And so you have like Andreessen's crypto arm, right? Or Sequoia China or whatever. You have these sort of pockets that exist, but by and large, they have a Chris Dixon who is the sort of, the leader of that fiefdom, right? But you have these kind of universes that exist within the firm. Progressively, that has continued to abstract even further to the point where now what I refer to in my writing is the renegades of venture, right? And that became a series for me that I've written about. I have focused a lot on people who are trying to take fairly different models and written about people who are doing things quite differently. But my definition of what it means to be a renegade in venture does not have to mean that it's this like radically different model, or it's like, venture debt 2.0 or whatever. It doesn't have to be crazy. It is honestly like it is a Logan Bartlett, right? It is somebody who is changing the way that they define themselves and things like that. You are a perfect example of that, and what you've built with your firm is that it becomes more about, you have a vibe, right? Like it's more about these vibes that people feel.
Chapeau, my friend. But I want to talk about so-so venture firms. People think I'm like this Charlie in the Chocolate Factory on venture. I'm not. I'm like the most cynical on venture. I think most venture firms are actually really, really substandard and poor. I want to understand, what do you define as so-so venture firms? What makes them average to you?
Yeah, I joke. It's kind of the line where they say, we know that half of our marketing budget is wasted. We just don't know which half. It's kind of the same thing with venture funds. Probably 80% plus of venture funds are not great. We just don't always know which ones they are, right? When I think about, and I think that a lot of firms are trying to be those good firms. I think it's had this sort of cottage industry vibe for so long that it's allowed people to just be very, substandard and just doing their own thing. In my mind, the characteristics that I look at when I think about like, what does it mean to be so-so? The three buckets that kind of come to mind for me, one is, it's pretty straightforward, right? It's economic performance. And Doug Leone said this with you last September. It's a quote that I use a lot, where he talks about the two most important things are number one, performance, and number two, teamwork. But if we don't have number one, nothing else matters. It doesn't matter what 3 or 4 or whatever is. performance is critical. And there are firms out there, and it takes a long time for these things to sort of catch up with you. But there are firms out there that even in this massive bull market that we've had, they have not returned enough capital to be able to justify, the carry that they've paid out to partners, or that they should have paid out, or whatever. Like, there are economic models that are going to crumble under the pressure of the market that we're going into now. So like that economic piece is critical. The other piece of it is cultural, right? Like, culture can kill firms, and there's definitely examples of that. And I think that there are even many well-regarded firms that outside in people would think are great, but internally they're eating each other. And eventually that spills out into the work, right? It impacts their performance. And then the third just being brand, which is what we're talking about. But this is also a Logan Bartlett joke, right? As we talk about how as VCs, we invest in these firms that have durable competitive moats, when venture firms it's largely brand, right? It's largely that competitive advantage that comes from a brand. But I feel like in my mind, it's this idea that, the market correction in particular, it didn't take very long for a lot of bad behavior to start coming out, right? A bull market has hidden a multitude of sins of, venture firms haven't had to be super aggressive in certain ways. Within a few months, you started seeing things like firms jeopardizing a company's survival, holding up funding rounds, demanding specific provisions be met, whatever. That behavior is going to get out too. Like, we're talking about the positive side of building a brand, but the negative side of brand and bad behavior, that can kill you too.
I think it's like threefold. It's like, fundamentally discovery. Do you have an innovative way to continuously and reliably discover the best generation of companies? Great example of this would be a Y Combinator on the very early stage, a Sequoia on the very early stage with their innovations around scout programs, around ARC. I think they've actually productized discovery continuously very, very well. So as picking, like, discovery is number one for me. Picking and winning is number two. Like, do you have an innovative way, or do you have a better decision-making process around picking and winning? Benchmark, in particular, are phenomenal. I'm sure you know are phenomenal at this. When they all want to win a deal, their circulation around a founder and their convincing is unparalleled. Would be that. And then helping. How do you help founders in a better and more scalable way? I think performance is an output, and it's the inputs there which make the output what it is. And I think my biggest concern today is actually what we should be concerned about, Carl, which is these so-so venture firms are going to continuously get funding because they're still getting DPI on Lyft IPOing last year and sending cash back to their investors, even though they're shit. And the last time someone went to them for funding was in 2012. And so the next question is, I get you on everything that you said, and I agree with everything that I said. We're on the same page. But it takes so long for a venture firm to die, and they've delivered DPI. Will they not just continue with another 10 years?
I don't disagree with that. I think it's all relative. I think that the idea of venture, like, this is something I think about a lot. I try and it helps keep me humble and honest and things like, I wrote this article a few months ago called "The Death of a Venture Fund," and I went and interviewed a bunch of people, and it is actually inspired by Roloff was on, I think, Invest Like the Best, and he was talking about this exercise that they do at Sequoia where they say, all right, the group of us in this room, imagine that we presided over the decline of Sequoia. What happened? What did we do wrong? Right? That sort of pre-mortem of evaluating what could cause the death of a firm like Sequoia. And so I dug into that, and I think venture has a lot of main character energy, but we forget that we're like relatively a baby, right? When you think about like financial services have existed for thousands of years, even software, at least as a primitive, has been, got like Ada Lovelace in the 1800s. Like, all of these things are very old. Venture is relatively pretty young, right? Like maybe the 40s and 50s and stuff. And so it's not even 100 years old. And so there's that reality, is that it's, as a sort of industry, it's very young, number one. Number two, we're getting to internet time, right? So maybe it took multiple decades for a firm to die in the 60s and 70s and whatever, 80s. Maybe it's taking a decade, nowadays or last few years. I think that pace is going to increase. Like, information gets disseminated more quickly, companies scale more quickly, for better or for worse, venture firms have an impact on them. All of those things are going to happen faster and faster. And so I think for folks like you and me, the thing that we have to do is to think, it's sort of to skate where the puck is going to be or whatever, right? Where, yes, it's going to take a long time. Yes, they're going to be competing for capital and stuff like that. But I think the rate of death can increase. It's not going to be like,
The rate of
or
death can only, sorry, I'm being deliberately divisive. The
yeah,
rate of death can only increase in velocity if the structure of funds changes fundamentally.
I think it's a question of like LP perspective, right? It's not because we can look at it and say, oh, we want to be these like cutting edge, thoughtful, innovative ways of doing things. LPs are fundamentally like very sort of like stable and secure and Sally principle, right? Same as last year. What have we done?
And loyal. When people send cash back, they feel obligated to then return cash back for the next funds. It's very difficult for the LP, to be fair on them, to get 3x funds returned and then go, thanks, Kyle, not coming back for the new one. It's very hard to do.
I think that's absolutely right. I think that is the reason for me why I am more interested in trying to build something is that it has this like longer term potential. I think that the difficulty is unseating anybody who is really powerful. I think
once you get to that Andreessen stage, it is joyous because you get to the LP mindset of it doesn't matter about performance. I just won't get fired and I get credit for being in them. Once you're in that hailed ground, it is absolutely joyous. Before then, it's not so joyous. So I totally get you there. I think the big worry that I have, and I'd love your thoughts on this, and again, I just kind of chat shit going off schedule. The reason for this is LP incentive structures. They're largely salaried and bonused, and they're not really aligned in terms of carry and performance-based. And so, of course, you would invest and get a 1.6x and do contrary and potentially get a 7x, because they might get fired if you guys break up and hate each other. If Andreessen doesn't work out, they got into Andreessen, well done. Shame it didn't work out. So what do we need to see change in terms of LP incentives to fundamentally change this?
I think that one of the things that I have thought a lot about, and I don't know, honestly, like in this market, I don't know what's going to happen. I think that the sources of wealth will change. I don't know how, when you think about, it's actually the family office circuit is a fascinating world. The ways that people make their money and the people who are brought in to help manage that money and stuff like that. I think that a lot of that is not likely to change. I think that the transition that we will see is that more and more of the wealth that gets created. If you think about this massive pool that exists, and this not to say, I think that there's a whole other bag to unpack for massive institutional endowments and pensions and things like that. But just within these like long tail pockets of capital that exists out there to go get, the question becomes, where is that wealth going to come from and does it turn over time? And it feels like the opportunity to be able to have wealth coming from different sources that think about things differently. Like already I have started to see, I feel like I kind of exist in two planes of existence on Twitter, where on the one hand, I have this very like venture tech heavy world. But then for whatever reason, I've kind of stumbled into this like, family office, institutional allocation, world on Twitter. And you pay attention to what those folks are saying. And progressively, more and more, family offices, the way they allocate their capital, they want to do things differently. I think we're still at like the very earliest inflection point. But I feel like some of those things are going to start to change in terms of the way that people want to manage that capital. What that's going to mean, how that's going to play out, I don't know.
Okay, Coatue does a 50x fund, shoots it out of the park, and here's your family office today, Kyle. How would you structure it, and what would you do in terms of your approach to directs, fund investments? How would you do it?
I mean, I think that one of the things that, so there's two things. So number one, there is diversification, right? I do actually think that there is an opportunity to invest in lots of different things. I really like the episode you did with Will. You talk about the sort of venture firms that aren't really venture firms. I think that there are a lot of people there's a lot of companies that shouldn't raise venture. There's a lot of great businesses that can get built without venture. Like there's all these different pools. And so I think that number one, there is a more disciplined approach to diversification. Number two, when you think about allocating capital to venture, for me, I think it goes back to some of the things that you talked about, right? Which is looking for allocators and fund managers that have these characteristics of being able to identify their unique funnel. But I think the biggest thing for me would be focusing on where the biggest pockets of high quality people are congregating. Like I think that there's still always the like halo effect where any founder, regardless of their previous affiliations, are going to go where those halo effects exist. And I think that's always going to be true. And there's always going to be the desire to allocate to the best firms or the most well-regarded firms or whatever. But for me, it is all about allocating to who has access to these pockets of people, these communities of people, and how are they building really deep long-term relationships with those folks. Because I feel like a lot of firms right now benefit from sort of like here and there deep relationships that continue to compound, which is great. But it's not just about how do you take a top of funnel of all companies, but how do you build a product that stays close to those people throughout their lives? Because I think there's a really exciting opportunity to be able to identify multiple points along an individual's life cycle to be able to engage with and allocate capital different ways beyond just, hey, how do we have the best top of funnel?
I want to touch on the network and the community there because you mentioned it. You said before it will get more focused on deep personal relationships as a landscape and as a like what will make one win. What is like more deep personal relationships actually mean? What does like community actually mean in venture? They're kind of fluffy words, respectfully, that are thrown around a lot. How do you actually think about it in practice?
So this goes back, and I mentioned it before, right? The article that I wrote about the unbundling of venture capital. It actually comes from, I mean, I focus it very much on venture and these, renegades and stuff. The idea was sort of born out of this article by David Perel called Naked Brands. And he goes through all these examples of the ways that different sort of industries are changing. So he talks about like fashion and sports and media and how people are progressively transitioning to trust more in people that they can empathize with versus just like brands that they can trust, right? So it's like progressively less about Coca-Cola and more about like LeBron James or whatever. That dynamic, I think, is a function of like, we're steeped in the internet. Like there's so much of what we see, so much information that to be able to, discern what we want to be associated with, there is this like essence, we talked about before, right? There's this essence of like vibes that people give off. And when I think about the deeper personal relationships, I think there is like more sort of like shallow functional relationships. And then there is the person who, you have an actual deep friendship with and relationship with. And that's not always, like a deep friendship is not always scalable to massive amounts of founders and stuff. But the idea, I think, is that every individual investor, every firm, like they're trying to articulate this idea of like, what job are you hiring me for, right? The sort of jobs to be done framework from Clayton Christensen. And you're trying to articulate what you're good at, what you can offer them, why they should, why they vibe with you and stuff. And I think that those deeper personal relationships are going to come, honestly, like from the way that people present themselves online. We can get into the sort of like, brand drenched-edness of venture or whatever, but I hope that it's not going in that direction. My focus is on people being able to sincerely articulate what their vibes are online and then being able to attract the right people that want to have a relationship with you.
Who do you think has done that best?
I'm not going to toot your horn. You're doing pretty good. You're doing pretty good yourself. The move into TikTok was Spades. That was pretty good. I think that when I think about, because there's also this element of like community, right? We've talked about community. I think that there are people who do community really well, right? I look at Y Combinator, and there's no question that they've built a generational community. I think that, and folks like Gary and stuff stepping into that role, like I think that they're going to continue to just be amazing. But I think the opportunity that exists right now is to create a really like an ongoing relevance in the relationship that you have with somebody. It's not a one and done kind of thing, right? Even YC, most people talk about it like, yeah, I was in the summer 2020 cohort or whatever, right? The summer 2020 batch. But to stay relevant, like that's a relationship. To be part of a program, it's sort of you're in it and then you're out of it, and what fun memories we have. To stay relevant throughout someone's life, that's having a relationship with them because you continue to be relevant to them. Candidly, I don't know that anybody is doing that well.
I think about it in terms of frequency, which is like frequent and often, and then infrequent but like higher quality. And I think when we look at these two different landscapes, the one I admire the most is the infrequent, because it's fucking hard to do infrequent brand well. And when we look at who does that well, it was Bill Gurley when Bill Gurley was writing, and obviously now he tweets more, but he released few posts, but when he did, they were seismic. I think Ravi Gupta at Sequoia releases few posts, but when he does, they really, really hit. Same with Pat Grady, annoyingly both at Sequoia. But he did 15 lessons from 10 years at Sequoia. It fucking hit so well. And again, very infrequent. On the frequent side for me, actually, like Elizabeth at Hustle Fund, actually, she has scaled quite a following very sustainably with a lot of volume, but actually consistently done very well. I think those two for me, like three, really stand out. I'm intrigued. I think venture brands, like funds, brand themselves terribly. Do you agree? And why do you think yes or no?
I think that the center of gravity has shifted to your point, largely to the individual investors. And I think there's very few firms that have kept up with that shift in the center of gravity. And so firms that are trying to push forward the almost, celebrity, if you will, of the individuals, that's a powerful dynamic. I think it's one of the reasons why anybody with a reasonably sized Twitter following probably gets at least job interest, if not a job offer from Andreessen, right? Like they recognize that sort of micro celebrity appeal of being able to hire anybody who has even remotely a sizable following. So I think that they are trying to tack on to that shift. I don't think anybody has done it well because it feels uncomfortable. Like it feels uncomfortable to have this like quote unquote brand, when today most of the way that people want to interact with institutions is they want to interact with people knowing that the institution has something has backing, right? But it's like that person represents the vehicle into that stuff. You don't want to necessarily be interacting with this faceless monolithic brand, but most firms' marketing efforts have not kept up with that shift in gravity.
I do just want to ask one final thing on the communities. That I agree on like the YC of the world, but like that's one very distinct. Have we really seen other venture firms try and build communities? And if so, what's the difference between those that have worked and those that haven't?
The short answer is we've seen them try. We haven't seen very many succeed. Some examples of this, even like Andreessen has some of these where they have like, Slack channels where they'll take the CROs of all their companies and dump them into a Slack channel. It's not a good community. It's an attempt at trying to like coalesce people into buckets, but it's not a good attempt. And so your question around like, what does it mean to make a successful community? In my perspective, and obviously I'm biased, like contrary is this is just our bread and butter. I mean, before we had a fund, we had a community of about 100 future founders, right, that we had met and were working with and things like that. So we have always tried to emphasize this people-centric community and building that. The reality of why it works is just like any product, if the customer is an afterthought, it's not going to hit. Like it's not going to be a very good product if it's secondary to something else, right? Even from a community perspective, you talk about people's scout programs and stuff. Those scout programs can be powerful. I think that you're going to see a lot of dilution in the value and quality of those scout networks progressively over time. And I think the biggest reason for that is because it is an afterthought, right? You implant this community with the hope that it leads to something else, which is deal flow or whatever. You're not necessarily super incentivized to make that community experience as high quality as possible. You're incentivized to get it to lead to something else. And at Contrary, we talk about this a lot, where we are as focused on our community members as we are our portfolio founders, because we hope that eventually one day they become both, right? The focus is on these people who will eventually be founders. We're going to help them at every phase of their career so that when they become a portfolio founder, it's not that we suddenly shifted and we're like, oh, great, now we can, stop, exuding all this effort on them as community members and now really focus on them as portfolio founders. The ideal is that it becomes this seamless transition. I don't think anybody has done that well because community has always been an afterthought, not the core product.
YC obviously went from 600 to now I think they've halved the batch size and they've got Gary back. I think this is like the biggest sign of strength from YC, and I was worried about them for a while. Now I'm like, fucking buy YC, long hold. Are you with me? And like, do you think they've just completely regained all power from the unbundling? Because we did see this kind of splattering of the unbundling of accelerators, which I think now power retained, concentrated, centralized. Do you agree?
Yeah, I mean, I think YC has built something, again, like I use this word, I try not to throw it around even though it's one of these buzzy venture words, but like I talk about having built a generational community because it is this sort of once in a generation thing that people have built and have affiliation with. I think there's nothing like it. And I think that the other thing that I don't even know that I would have ever said I was worried about YC per se. I think that the like drive to excess and having more and more people, it dilutes the experience on the micro for sure. Like individuals' experience can be more negative, but I still think it's getting them exposure and closeness to really high quality people. But I think the biggest thing is that it's a compounding effect. Like no firm compounds the way that YC does, because it's so expansive and so involved in all these different aspects and can bring people in these different ways, that I think like that compounding effect on YC is not going anywhere.
Yeah, no, listen, I totally agree. Speaking of kind of compounding effects and power, there was something that we kind of went back and forth on before on emails, and it was your concern about the Blackstone of innovation. And I thought it was really interesting kind of phrasing. What did you mean by the Blackstone of innovation, and why are you concerned about it?
So I'd credit Gabby Goldberg is the one who first, she and I riffed on this idea back and forth, and I thought it is super interesting. So I read the biography of Steven Schwartzman, the founder of Blackstone, a couple years ago. And there's this quote that really struck me where he talks about how they build businesses. And the idea was basically like, if we come across the right person to scale a business in a great investment class, why not? We can apply our strengths, our network, our resources, whatever. Like they're so focused not on being like we're not just a private equity firm. We're not this, we're not that. We are everything. And now they're effectively a holding company for financial asset class, right? 800 billion of AUM. They've got private equity, real estate, hedge funds, credit funds, whatever. They're constantly they think of it almost like exposure. And I feel like, so somebody, I don't remember who, but somebody said this idea that building a business, like 80% or something of building a business is kind of the same thing across the board. It's that 20% that's super unique to the company and the market and the circumstances that is kind of the secret sauce. And if that is true, I feel like Blackstone has done a really good job of figuring out what the 80% is they've just built this like infrastructure, that kind of AWS of raising capital and deploying capital towards XYZ strategy. They figured that crap out. And then they just focus on, hey, how do we go find that person who represents the secret sauce, that 20%, and we plug them into the infrastructure and we let them go nuts and we just scale to this big thing. And I think that the firm that most closely resembles that in venture is Andreessen. The way that they have approached things like, gaming and crypto and biotech and so like that, that's sort of them saying, hey, we have this fundamental infrastructure of brand, of thought leadership, of, capital raising, whatever, portfolio support, whatever, if that's valuable. They have that infrastructure. And if they can take, to your point, if they can take, 1.5, 2x return thresholds, people can park their money there. And they can just deploy, they can go take big bets, right? Like giving Adam Newman money for round 2, like things like that. Like it's just sort of this like massive calculus of, we have this infrastructure, how do we bring in capital and deploy it, at scale? I think Tiger to some extent tried to do that, though they may not have nailed the 20% specialty. But that's the kind of thing you're seeing.
Is this good for our ecosystem?
So one of the reasons I characterize it as something that concerns me is because I think that like capital allocation and portfolio construction, like those are macro activities, right? Like when you think about there are firms, like I said, you think about it as exposure. Like I have heard large multi-stage firms talk about things like, hey, we've got 15% of the portfolio allocated to fintech. I'd like to get some more allocation in that. It's almost hedge fund-esque in the way they think about where are they allocating their portfolio and stuff. That's a very macro game. Company building is micro. Like especially in the earliest stages, it's people, it's lives, it's families, it's customers, it's jobs. Like I think that once and it is appropriate to have a certain level of abstraction, right? When you're thinking about like, hey, like at the end of the day, this is a capitalist exercise. We're trying to take in capital and maximize the outcome of capital. Like that's okay. It's okay to have that abstraction. At some point, if that abstraction gets so far removed from this sort of fundamental company building aspect, I think that you start to get into some dangerous territory. Because when those companies fail, when they get tons of capital and all this thing, and it's an exercise in portfolio construction and capital allocation and all this stuff. When those companies fail, like it's a blip on the macro. That's okay because it's 35 billion of AUM or 800 billion of AUM or whatever. But on the micro, it's everything for a lot of those folks. And I think that abstraction causes some breaking points.
I think also there's two things that are fundamental, which are fucking hard to maintain, and I think many challenge to do so. Is number one, like you mentioned there with Blackstone, find amazing people and move with them. I don't think all of the firms that we've mentioned find amazing people and move with them. They move to the space that they like and then look for people. Very different, I think. And then number two, I think, is the temporal diversification of product expansion, which sounds very nerdy, but what I mean by that is like earning the right to do the next financial product and not doing 5 in 2 years, because what you do to your morale is fuck it overnight, bluntly. And if you do it if Conturi adds a new vehicle every 3 years, you can stage your culture progression in a much easier way than here's 5 new products. And I think that's a core challenge that, I think some people have faced. I think my question to you here, though, is like, it gets to a stage with also fund sizes, Kyle, where it's almost easier to raise 2 billion than it is 200 million. And the reason I say that is because there is a pool of LPs, as you know, the pension funds of the world, who need to move 100 million, can't get into Sequoia, struggle to move that much into Founders Fund, for sure. And so where do you go? There's not that many places. And so you have this finite supply of homes for your 100 to 250 million. This is where it makes sense. Do you agree with that analysis?
I agree with that. I think that one of the reasons for that is that for a long time there was kind of this arbitrage in venture, where I don't know that people fully especially, the internet is sort of the thing that this was the like massive multiplier on all of these outcomes. And so nobody appreciated venture as a place where large amounts of capital could be effectively allocated to maximize returns. I think there was an arbitrage in that that existed, where they had shockingly big outcomes. And over time, people have realized how big those outcomes can be and have paid more and more attention to it, which has attracted more and more capital. One of the reasons I get concerned about that, and I understand the like fundamental math that people are doing to say, hey, if I can allocate X amount of capital, if I can expect a certain rate of return, like this is a place where I can park money, and that's okay. And I don't disagree with that. Like people are welcome to do their best in whatever capital allocation strategy they want. The reason I am worried about the sort of excess capital is because there aren't really like guardrails or good standards of excellence before, right? It's again, this idea that like enough money can hide a multitude of sins, right? Like we've seen it over and over again of bad products, bad go-to-market, bad unit economics. Like they can all be covered up just by having enough cash. And to your point, it's not that there's a lot of cash and it's being allocated to good managers who are going to do their best to invest that in really good companies. It's to whoever will take it to try and get exposure to this market, and I worry about that for sure, because it muddies the water for everybody else, right? When everybody has so much cash, we're seeing this pullback now with this market correction, which is is sort of tapered some of that, but I don't think that that's going away. Like I don't think that people are just going to say, oh, never mind, venture is actually not that great of an asset class, back to bonds and real estate. Like I think that people recognize that there are still large outcomes to be had here. And so there's still going to be that excess of capital, and what we do with that and how companies react in that world, it's something that every company has to worry about.
What are the biggest changes that you've seen post the correction that we've had over the last 6 months? I tweeted the other day about some trends I've observed. What are some big changes you've seen?
The first one that comes to mind is what I would describe as almost like a suspension of your own criticism. Like I think like we went through such a phase of people just pumping everything they possibly could, rampant intellectual dishonesty, all these different things. And I'm surprised. I thought that it would be more humbling for more people. I think that there's been this sort of like suspension of criticism. Like people are desperately trying to avoid having to come to grips with what they did, basically, like with what a lot of people did over the last couple of years. That worries me a lot, because I think that like this is a great opportunity to sit back and reflect on what should we have done differently, what could you have done differently, whatever. So I think I expected a little bit more of the like, mea culpa. And there's not been much of that at all. So that's certainly a trend of like people just trying to move on to the next thing or whatever. The second thing I think is that companies are more thoughtful about like what matters most in the way that they build their business from a storytelling perspective. Like I think that before it was just this idea that like, hey, like if you have a pulse and you have some indication of an interesting market or whatever, there's going to be enough people that get jazzed. I think that now I've had a lot more conversations with founders, both in and outside of the portfolio, where we're talking about what should I focus on my business and how can I articulate that to investors to indicate the quality of my business. It's not just about the big picture story, but it's about where should I be focusing to be able to articulate my story of why my unit economics are working, or why my market is sizable, or why I do have product market fit, or whatever. There's more of that, where I feel like a lot of that was just swept under the rug because it was so focused on like how I tell just the biggest story I possibly can.
Are you seeing pricing change?
I've seen chickens with their heads cut off running around trying to figure out what a price is, what the right price is. It's insane to me, the conversations I've had, especially because most of my bread and butter is not necessarily the like pre-seed seed stuff. Contrary has done that by and large. I joined Contrary to help build out our ability to invest more in like Series A, Series B, Series C. And those companies that I'm working with, there is no rhyme or reason. There's no valuation. There's no thought process. There's certainly not a acceptance of down rounds for the most part, beyond the like very late stage folks that are just engineering capital raises at this point. But in the stages that I work at, like there's certainly not been an acceptance of down rounds. And there's not been, I think, so I wrote this piece a couple months ago. I was like blown away by, I was honestly like almost a throwaway piece that I was just like, I was trying to work through some thoughts in my head. I put it out there and it was one of my most popular pieces. And it's called What's an Evaluation, where I unpacked the idea of like all these dynamics that go into evaluation. And the number of times, I'm shocked by the number of times I have a conversation with different founders and I explain venture math, basically, like very, very back of the envelope, simple stuff where it's like, listen, if your valuation is this and your revenue is this, and if I look at the next 5 to 7 years and you have to go from where you are to hundreds plus millions of revenue, there's going to be a dilution along the way. So my ownership is going to be X. And when you get to that point, if you look at the public markets, they're trading at these ranges. And then you'll trade at those ranges. This will be our return. And that's the factor. Like if I can't get that math to work, granted, there's so many ifs in that statement of like, if you grow at this scale and if dilution is this and if multiples are that, we can't predict all that stuff. But just doing the math is like the sense check that you do to say, does this make sense? And for people who are doing these deals at, multiple billions of dollars for, a valuation for companies that are generating sub, 20 million of revenue or whatever, like that math is really, really, really difficult to get to. And the number of founders who are like, that's just not a way that they think about things always surprises me because it's different math. But that's the math that people were sort of just like fudging and ignoring for the last couple of years. But it's a reality that's going to punch a lot of people in the face.
Question, did you invest too fast in this boom period? And did you lose price sensitivity? I lost both.
I think at different points in time, I invested too fast. Price sensitivity, I think, is the thing. I would say that my bigger mea culpa that I look at is like appreciating the weight of gravity of what it means to build a massive company. So the way that I think about this is like the number of, again, I'm investing sort of at the later stages, the number of models that we built to be able to justify certain valuations. The number of them scaling to over $1 billion of revenue over the course of 4 or 5 years to say, well, if they scale to over $1 billion in revenue, then this is the return, and it can be a very healthy return, and that's our base case, and it's like, that's an insane base case. Like, when I step back and think about how many companies in the literally hundreds of thousands of startups in the world that exist, that have existed, how many of them have scaled to over $1 billion of revenue? Like 200, 300 or something, right? Like it's a tiny fraction of companies that have truly gotten to that massive scale. And so when you step back and think about that, I think that was the thing that like I used too easily to just say, well, if we can paint the most optimistic financial picture, sure, anything makes sense. And now I often find myself reflecting on that and thinking like, I want to go compare this to like the companies that actually went up against gravity and did have to scale year after year after year after year, achieving growth rates and adding new customers and launching new product lines and stuff like that. What did that look like? And much more often than, it's crazy the number of things that we've seen like Wiz talked about this, and Deal talked about this, and there's a bunch of these companies talking about like, hey, one of the fastest companies to get to 100 million of ARR or whatever, and that's great. Like there are companies that can be those massive scalers, but by and large, when you look at those companies that have sort of defied gravity, they almost never do it in these explosive nonlinear paths. They're just compounders. Like very quickly they get to that sort of, maybe 30-40% growth, and then they just crush it for a long time. You have the Snowflakes of the world, but even Snowflake you look at, right? They're getting to $2 billion of revenue, insane, massive growth, 11 quarters of over 100% growth. But it eventually tapers off, and it's just, have you built an effective compounding engine or not? And I think that for me, that price insensitivity translated into not respecting or being reverential to how truly difficult it is to build one of those massive companies.
Listen, I want to move into my favorite, which is a quick fire, Kyle. So I say a short statement. You give me your immediate thoughts. Does that sound okay?
Sounds great.
So what's your favorite book and why, Kyle?
So I have on my personal website this thing I call my Quake books, like the books that shook me. And so my most recent addition to that is this book. It's called Reinventing Knowledge by Ian McNeely. It got me obsessed with this idea about the Republic of Letters, basically just this study over history of the world has been changed largely just through people writing personal letters, really smart people trading personal letters. And so now I'm obsessed with this like Republic of Letters 2.0 where, Twitter DMs are going to change the world.
Who is the most underrated angel in the ecosystem and why them?
So my favorite person to work with lately is Amjad Masad, the CEO of Replit. I think the guy is an oracle. Like there's just a shortage of ambition in the world, and every founder could benefit from having Amjad on their cap table because he just brings such an ambitious perspective.
How did you get involved in the Rome app community? I heard this was one I had to ask.
I have been an obsessive note taker in my life. There's a scripture that I jokingly quote. It's whatsoever you record on earth shall be recorded in heaven. Like I am a dogmatic note taker, and I'd never found something that worked the way my brain works. And I was watching this YouTube video with Tiago Forte, and he was interviewing Connor, and I felt like I had stumbled on a prophet. Like I DM'd him, I had to talk to him. Our first call, very unorthodox. He was shotgunning whiskey and Red Bull and lighting a cigarette with a blowtorch. Definitely one of a kind founder call. But I went on to do 100 personal Rome tours because I just love the product so much, and I'm still to this day an hourly active user.
Tell me, what's your biggest miss and how did it change how you think?
Back in the day, we passed on Coinbase at 1.5 billion. Still ebbs and, you look at the market cap, it's definitely a big up and down. But for me, the reason I think about that pass specifically and that missed opportunity is because the failure was a failure to imagine a colossal shift in user behavior, like how big those shifts can be when they happen. And there's still a question to be had about like what is going to happen. We went through this crazy bull market. There was a lot of speculation. I think that it's still around to stay. For me now, when I think about my like what do you have to believe equation, I just wrote an article about this. I try frequently to ask myself, what's something that I strongly believe right now that I'm probably wrong about? And to try and constantly call into question those activities. Because I had such a strong belief in the consumer shift not happening for Coinbase, and I think it has.
Tell me, what's your biggest hit so far, and how did it change how you think?
So I think there are investments that I have made that have done really, really well within the firms that I've worked at. For me personally, the biggest impact of an investment that I have made was a company called TeamShares. And it reminds me of the quote, I think it was with you, Keith Raboy, talking about, I measure success based on how many of my peers think I'm insane or laugh at me. So when I invested in TeamShares, there was a couple of people with an idea. The idea was to basically buy small businesses, turn them into ESOPs and scale them almost like a holding company at scale with services and stuff like that. And people thought of it as it was just like a private equity play or whatever. But effectively, it was this like fintech mechanism to be able to make employee ownership of not tech companies, but of, salt of the earth types of businesses and increasing that equity ownership that exists. And there was so much skepticism about that. And that has, financially, it's been very rewarding of an investment. But also just seeing this, what felt like to a lot of people, a sort of laughable idea, just execute incredibly well. Like that has reinforced my perspective as an investor to think about like, what are the things I actually believe in, not are just the things that I think people won't laugh at me about.
Is the growth market better or worse in 12 months, and why?
The growth market is likely to be better in 12 months. Only if you see that shift. I talked about with founders, there has still, I think, not been a reality check of what valuations really mean fundamentally. If that reality check continues to occur, like I think if progressively founders recognize what that means, I think that the growth market can improve. It's going to come down to earth. Valuations are going to be a lot lower. It's still going to be hard to fundraise, but it's not going to be what it is right now. What it is right now is you have two sides of the party. One still convinced that they can get $1 billion valuation for, because before it was 3 to 5 million of revenue could get you $1 billion valuation or pre-revenue. Now it's like, but we've got 10 million, we've got 15 million, we want $1 billion. Like that mentality. And then you've got a bunch of investors that are, again, sort of chickens with their head cut off, running around, having no idea how to price anything. Both of those things, I think, are going to improve over time. Investors are going to get more thoughtful about valuations. Founders are going to get more thoughtful about what does valuation mean to them and what is success versus what they wish they could get.
I find we're seeing like two different worlds in growth, which is like the 98% and the 2%. The 98%, it's a desert, you cannot raise, it's impossible, really challenging and hard. And then the 2%, there's this real concentration of capital or flight to safety, where there's very obviously very brilliant companies, not Figma, but your Figma-esque of the world, which are guaranteed, as much as you can say guaranteed, to be very generational defining companies. And they will continue to be able to raise at very high prices, maybe a 10% discount, but not really. And you're seeing actually a concentration of capital to the 2% there, where it's much more concentrated. Do you agree with that?
Yeah, that's what I have seen. I think that there has yet to be a company like that. Because even when you look at like some of the high profile failures that we've seen, I don't know that any of them were like, oh my gosh, they were just the darlings, the high flying, I mean, even when people talk about stuff like Theranos, Theranos. When you talk about Theranos, maybe a better name. But it's like there's very few sort of traditional VCs involved in those. Like that's very rarely the darlings. I think the only way that flight to safety like gets rocked is if there is something where you're like, I thought this was just a darling. Like everybody was convinced that this was a generational company and it just absolutely imploded. And I don't think we've seen that, which reinforces for people that flight to safety.
No, I agree with you. I think it's coming. What would you most like to change about the world of venture?
I wish there was a better way. We talk about this a lot because we're so community focused at Contrary. I wish there was a better way to de-risk those earliest days of starting a company. Like I think that there are a lot of ambitious people sort of trapped in a systemic risk intolerance because of their circumstances or whatever. And I wish that we could lower the bar for that risk curve. Like it's scary because as a capital allocator, I have to think about risk management and I have to be thoughtful about different risks. I try as hard as I can to not let my biases that exist for everyone stop me. But I wish that we could de-risk that sort of journey into being able to build something.
Final one. What's the most recent publicly announced investment, Kyle? And why did you say yes and get so excited?
So I had the privilege of getting to lead an investment in Pave while I was at Index, and then to very quickly jump over to Contrary and be able to invest at Contrary as well. And so Pave, for context,
in the same round.
The same round, yeah.
I love that. That's brilliant.
Worked it perfectly. I'm a huge fan of these businesses that can take just like massive critical, corpuses of data and make them accessible and actionable, and then make it possible to build. They kind of become a new foundational layer upon which to build new things. So you think about like some of the investments I've made, like, Ramp does this with expenses and receipts. Like Packy called it the transaction layer of a business, right? Toast did this on the restaurant ops side. Persona does this with user identity. So Pave does it with compensation data. So they've built this just massive database of compensation data for tech, and now that data, like they can build on top of it in terms of like compensation planning and offer letters and all these different areas to give people more visibility into what the job market looks like. And over time, when you have that like real time lens on the labor market in tech, the opportunities are pretty compelling. That's really difficult data to sort of wrap your arms around. They've done a really good job of it.
What's the data entry and acquisition strategy there? Because obviously with Ramp, like, you have the core card and you have the core account, which then lends to the flow of the data, which is the transaction data, which you can then act on. Here, they don't, unless they're like the payroll provider, I don't understand where the data acquisition strategy on, internal team salaries and compensation is.
It is their sort of Trojan horse is a give to get data model. So if you plug in and you could do this with your firm, any company can do this, where if you plug in your HRIS to be able to offer up your salary data and your cap table management to offer up equity data, you get access to their benchmarking module. So you can see all these different cuts of different salaries and stuff like that. So that's the data ingestion, is this sort of give to get, completely free. They've got over 600 different venture firms that are partners to be able to pull it, roll it out to their portfolio. It's on that foundation that they then build things that they monetize on, like compensation planning and stuff like that.
I totally get you. I like the give to get. Carl, listen, as you can tell, I've so enjoyed this. I love kind of freewheeling conversations like this. So thank you so much for putting up with me. And I so appreciate the time today, my friend.
Thanks for having me. It was fun.